morning and welcome to the Saxo Bank Morning Call. It is Tuesday, December 18th, and starting off the week, gentlemen, with another ugly session on the S&P 500 in Wall Street with the lowest close, at least for the S&P 500, since October something or other of 2017. Look at a chart here, we can see that the actual lows intraday on the cash index just touching and I think exceeding maybe by a point or two the intraday low back in that scary sell-off back in February. Was there any sector you saw leading this, Peter, on the declines yesterday, or is it just sort of a general sell-off in your view?
We still have the classic sectors driving this with the technology. Technology sector is down 17% from the peak now, so that's obviously the weak spot. But otherwise, there was no specific news that was driving this sell-off yesterday. So it seems a little bit like randomness.
I think we were talking about this. I think in some way the market is almost crying out here for Fed intervention, for Powell not to hike. It's still priced in around 2/3. We'll get to a chart on that later. Where do we go from here if the Fed is not cooperating? And where are support lines below this these big lows here, Kim?
Well, that's actually quite interesting, John, because I can't really see any until 23 a little bit, maybe 2400 could be where we have the strongest support, but there's no real support. Because if you go back in time, I mean, prior to 2018, 2017, 16, it was more or less just an upwards move. No correction.
So there's just an air pocket if we're not getting the confidence back in the market.
There's like an air pocket.
And when you look at the NASDAQ 100, you brought a chart, Kim, on this one as well. We're not quite at those lows from back in February there, but you think that's something we could test there as well?
We could test it, and we could still see some volatility coming up until the FOMC tomorrow, and even around that, of course, and after. So, but yeah. 6,300. You can see I have used the closing prices, so it's actually peaked a little bit lower back in Q1. But as you can see, there's not really much support before then, and since the negative sentiment has kicked in, I mean, there's really not much holding it.
Okay, Peter, you made the interesting point back this morning as well. That actual low we saw back at the beginning of the year, if we do attain that low, that's actually right around the exact definition of a bear market. That would be a 20% decline from the 7,700 highs in the NASDAQ 100.
Exactly. That was the index future we were looking at there. But I still think that we are in for a very critical week, so we have to be extremely careful. As we mentioned yesterday, we have that FOMC tomorrow, and then we have the Chinese convention or Congress on Friday. I think that's two pretty big events, so we have to be careful here.
Big two-way risk. We can't call a bear or a bull here.
No, but I'm the first to admit I wrote my equity monthly, and I was definitely, now in hindsight, too positive here in December, and the Huawei was took markets off into a decline, but I still see. I think the market is overreacting a little bit against some of the things that you're seeing. But having said that, it doesn't look very pretty.
And if we look at Chinese equities as well, we have a chart here. The speech so far overnight from Xi, by at least the commentary I'm seeing, not indicating any dramatic new direction, but there could be yet, of course, initiatives forthcoming.
I think he was trying to bolster some nationalistic sentiment. He was saying that China, chooses its own path, and they're trying to create a world order where you have multiple development models. i.e. we will not converge to the US view.
Yeah.
Hence, the rivalry will continue for decades. I think that's what we've talked about so many times, John. And if you look at the price, the chart reaction here, you can see the price reaction. You can see that it declined with U.S. equities, not as much, but we're basically in this very narrow band right now, and we need to break out to either of the sides to see some action in Chinese equities, and hopefully it will be to the upside, because if we break below that 3,000 in the CSI 300, I think we have some very, very, very bad feedback loops coming into the Chinese economy because of all the stock collateral and things that's going on in their market economy.
Yeah, and we talked a little bit about, of course, we have this upcoming FOMC meeting being the real key here for market sentiment. But we talked a little bit about what are the drivers here. I think one of the things the market is not enjoying contemplating is the prospect of another government shutdown, which appears on the way as Trump is not getting the dollars he wants to fund that border wall. And as well, we saw another pretty ugly miss on the U.S. The key housing survey, the NAHB, Peter, and that dropped by an enormous amount the previous month, but it dropped another 4 points this last month.
And it's a fall off in 2 months now.
These key interest rate sensitive sectors really showing signs of being activity decreasing. You did notice, or on this chart, you've indicated here intraday. However, if we index to 100 at the beginning of the day, that the home builders actually outperformed the broader stock market index.
Actually, quite interesting to see this outperformance intraday. It tells you probably that some of that was already discounted.
Maybe some exhaustion.
Yeah, and potentially there could be some defensive coming in. As I said, there were some of the most. I would say the technology stocks were more hard beaten yesterday. But what we talked about before going into the studio, we should have broadened this chart out going 1 year back. Because
it does not look pretty since for the beginning of 2018.
Exactly, and that is, we have to be honest, that's the worry, right? We have the housing and we have the financial stocks. They're not looking quite positive at this point in time. They are leading the declines.
As we can see, also the ETF for home builders has dropped like 30% since the peak.
Yeah, whereas the broader index tried to come back and post new highs, the home builders, they never look back after the decline in the early part of the year. Just to show you where we are in terms of Fed expectations, a bit more broadly speaking, how much we sort of repriced the Fed out into 2019. I brought this chart here of the Fed funds future for December 2019. You can see the better part of 2 full rate hikes have been priced out of those expectations. So we still have a 65% odds, supposedly, of a rate move to tomorrow's meeting. I think if the Fed does move, we're going to see something extremely dovish on the guidance, maybe some sort of language indicating a second guessing the current quantitative tightening schedule. I don't know, but I think consensus is a dovish hike, and I think it'll be either an extremely dovish hike or we could just get that shocking no hike because of the degree to which markets really seem to be suffering into this decision, and key financial conditions indicators like junk bond spreads, etc., starting to move the wrong way. Briefly, we wanted to note as well the weakness in the crude oil price. Brent is hovering near those lows below 60, but WTI in the U.S. actually going below 50 for the first time in quite some time. A big signal there for the energy market, and Peter, no doubt in the energy sector in the U.S., where some of these shale, this $50 issue level is bandied about as a key one for profitability in the shale oil sector.
Yeah, but interestingly enough, in this short-term cycle we've had with declines, the energy stocks have actually been doing quite well, which is and also their credit has still not been sold off dramatically. It has been other parts of the credit market driven by GE and the likes. So it seems like for now in the equity space it's a little bit contained, but surely if we get further down, and we have to.
There'll have to be stress if we're getting down to $40 or something like that on some of these shale players.
Of course, some of them do have break-even levels below this, but on the margin, some players will be hurting at these levels. But it should be good for consumers.
Most definitely, yeah. We talked about that as well. That's a bit of a tax break for consumers to have oil prices easing off so dramatically. A little bit linked to oil. Let's look at Euronoki here. It is breaking to dramatic new highs, but we have to note the time of the year. This is Friday was the last day that the Norges Bank in Norway carried out Norwegian krone purchases to fund budget deficits, and so they've eased off of those purchases. It allows Euronok to slip higher. Of course, they take up those purchases again at the beginning of the year. And if we note also on the chart, actually back that last that big rally or sell-off in the NOK rally in Euronoki at the end of 2017 saw a similar pattern where it set dramatic highs for the cycle before pushing way back lower to start the year. I think there's a little bit of an element of worry though that if the oil price remains weak, maybe the comeback in Noki could prove a bit more curtailed. And then on dollar yen, we finally seeing a bit of the yen safe haven trade coming into view here. It's been a pretty weak safe haven bid for the yen. A bit surprising given the degree to which the U.S. long end of the curve, long yields have been heading lower. Normally you would expect risk off and lower yields to feed a stronger yen still. But notice that Ichimoku cloud support there. That's been playing cat and mouse in that with that level for months. Down in the low 112s, maybe 112.50 actually, not quite low 112s for a move lower. And Kim, you've brought us zoomed out a bit here, looking at this big triangle in the dollar yen chart.
Yes, and we should break out. Well, it can take a couple of weeks actually, but on top of your Ichimoku cloud chart, John, we have this triangle lookalike pattern here. Currently, I would say I'm to the upside. So if we get a close above 114.5, around that level, definitely 115, 116 is in the horizon.
Yeah, that would fit well, even if the Fed does go a little bit dovish. If the response is a very strong risk on, that doesn't tend to favor the Japanese yen, and you can see a lot of upside in yen crosses. Maybe the dollar yen participating less enthusiastically than other yen crosses, but it could meet a weaker yen in such a scenario. So that would dovetail with that scenario. So let's take it to the economic calendar for today. Not a busy calendar. We do have Norges Bank's Olsen out speaking. That could be interesting given what's going on in the Norwegian krona. Germany, we're very concerned there for the cycle, but this IFO is a bit slow to absorb or indicate anything. The survey there, some Canadian data, and then maybe some U.S. housing data getting a bit of attention as well. The housing starts have been weakening there as well, and of course, the event of the week is the FOMC meeting tomorrow and what the Fed does there. We'll talk more about that tomorrow. I'm not sure I have a bead on what's going to happen. I thought for sure they're going to hike. Somebody as interesting as Paul Tudor Jones was out very recently saying he thought there was too much momentum in the Fed's guidance for them to pull back already here and not move forward with a hike. But it's pretty, given where markets are now, they're already a different place than they were 10 days ago or whenever it was that Paul Tudor Jones said that. And then for the rest of the week, a few more central bank meetings. The Sweden Riksbank is the most interesting of those in terms of the signal because we don't expect anything from the BOJ or the BOE. And then we have the latest PCE inflation data out of the U.S. On Friday. And then, as I noted in the pink there, the U.S. government shutdown issue has become suddenly very relevant. And this Brexit vote date is moving around a lot. It has moved forward rather than back to something like the 14th, or at least the week starting the 14th rather than the week after that. The situation is getting very dynamic with the Brexit vote as well as whether we switch to a second referendum scenario. That'll be it for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks.